Every night while you're asleep, your bank is busy. Your $20,000 isn't sitting still in a digital vault somewhere, patiently waiting for you to come back for it. The moment you made that deposit, the bank put your money to work, and every dollar of profit from that operation flows back to their balance sheet. Meet Lisa. Lisa did everything right. She saved 6 months of expenses in a savings account at a major national bank. Every month, she watches a small interest deposit arrive, and it feels responsible. Safe. Her account pays 0.42% APY, right around the national average. On $20,000, that's about $84 a year. $7 a month. Meanwhile, her bank is doing something entirely different with that same deposit, earning multiples of what she receives, and she has no idea it's happening. Then there's Chris. Chris has done his homework. He found a high-yield savings account paying 4.35% and moved his money there. He now earns roughly $870 a year instead of Lisa's $84. More than 10 times more. He thinks he solved the problem. And in one real sense, he's way ahead of Lisa. But there's a question Chris never asked. His bank is running the exact same profit operation on his deposit that Lisa's bank runs on hers. He just negotiated a better rate from the same middleman, and the middleman is still walking away with most of the profit. This video is going to show you exactly how that machine works, what your bank earns on your money while you sleep, and walk through a third option that neither Lisa nor Chris ever considered, one that cuts the bank out of the picture completely. If breakdowns like this are useful to you, subscribing ensures you won't miss the next one. The core business model of every major bank in America operates on a single principle: pay depositors as little as possible for the use of their money, then lend that money to others for as much as possible. The difference between what the bank pays you and what it earns by lending your money out is called the net interest margin, and the current average for U.S. banks sits at around 3.39%, the highest that figure has been since 2019. Here's what that looks like in real numbers using Lisa's deposit. Her bank pays her 0.42%. It earns an average of 3.39% on what it lends out. The spread between those two figures is about 2.97%. On $20,000, that comes to roughly $594 per year, flowing back to the bank from the gap between what they pay Lisa and what they earn using her money. Lisa gets $84. The bank captures nearly 7 times that amount from the same deposit in the same 12 months. That $594 only reflects average lending activity. The real margins get substantially wider when you look at specific products. Credit cards currently carry an average APR of around 21%. Auto loans sit near 7.5%. Personal loans average closer to 12%. Every one of those products is funded in part by deposits exactly like Lisa's, and everyone earns the bank multiples of what Lisa receives for effectively lending them her cash. Then there is what might be the most striking part of this picture. A portion of Lisa's deposit gets used to buy short-term U.S. Treasury bills. 3-month T-bills are currently yielding around 3.6%. The bank collects that yield on a government-backed, essentially zero-risk asset, while paying Lisa less than 0.5%. And here's the part that matters most. Lisa could buy those same Treasury bills herself, cut the bank out of the equation entirely, and keep that full yield. The bank is positioning itself as a middleman between Lisa and the federal government, and collecting over 3 percentage points per year for that service. Beyond the spread on lending and the Treasury trade, banks layer additional revenue streams on top of their depositor base. U.S. banks collected an estimated $12.1 billion in overdraft fees, maintenance charges, ATM fees, and related service charges in a single year. Major institutions individually cleared over $1 billion each from overdraft revenue alone. Now, someone who keeps $20,000 in a savings account is probably not racking up overdraft fees personally, but that income is still generated by the same pool of depositors that includes Lisa's money, and it funds the same operations her deposit supports. Every time she swipes her debit card, her bank earns a small interchange fee from the merchant. Every time a payment clears, the bank earns float income from holding the funds during the settlement window. And the behavioral data from her transaction history gets packaged and used in ways that generate revenue entirely invisible to her. Stack all of that together, and a clear picture emerges. Lisa's bank did not hold her $20,000. They rented it. They paid her $84 for a 12-month lease on her money, then deployed it across lending products, government securities, and fee-generating services that returned multiples of that figure. She received her $84, thought she was earning interest, and thanked the bank for the privilege. Most savers in America are doing exactly the same thing. Now let's talk about Chris, because Chris is the person watching this right now, thinking he already figured this out. He moved his money to a high-yield savings account, paying 4.35%. On $20,000, that's roughly $870 a year, compared to Lisa's $84. He did his homework. He made the switch. He is legitimately earning more than 10 times what the average savings account holder earns. So, what exactly is the problem? There are 3 problems, and they compound on each other. The first is that 4.35% may not be what Chris is actually earning. Many high-yield accounts use tiered rate structures where the top rate only applies to a limited balance threshold, with lower rates applying to everything above it. Others offer a promotional rate for a limited window and then quietly reduce it. The headline rate and the effective rate are frequently not the same number, and the difference only becomes obvious after you have already committed your money. Chris saw 4.35% in the advertisement. His actual annualized return may be noticeably lower once the account structure is examined closely. The second problem is tax treatment. Interest earned in a savings account, whether traditional or high yield, is classified as ordinary income by the IRS. That means it gets taxed at your full federal rate, plus any applicable state and local income taxes. If Chris sits in the 22% federal bracket and lives in a state with a 5% income tax, he is losing 27 cents of every dollar of interest before he sees it. His $870 in gross interest becomes roughly $635 after taxes. He upgraded from Lisa's account and is genuinely better off, but the tax treatment is quietly taking a meaningful bite out of every dollar he earned. The third problem is the one most people never reach, because the first 2 are already enough to feel satisfied. The real question is this: where is Chris's bank getting the money to pay him 4.35%? They are doing exactly what we described with Lisa's bank. They are lending his deposit out. They are buying treasury bills. They are running the same spread-based profit operation. The only difference is that a high-yield savings account shares a slightly larger portion of that profit with the depositor. The bank is still in the middle, and the middleman is still collecting a cut off every dollar Chris earns. The question Chris never asked is the one that changes everything. If his bank is using his money to buy treasury bills and keeping the full yield, why doesn't he just buy those treasury bills himself? So let's run the actual numbers. Same $20,000. Same 12-month period. 3 different scenarios. Scenario 1 is Lisa's traditional savings account at 0.42% APY. She earns $84 in gross interest over the year. After federal and state taxes at a combined 27%, she keeps roughly $61. That is what 12 months of disciplined saving earns her at a major national bank. Not enough to cover a single car repair. Not enough to cover 1 month of utilities in most American cities. Scenario 2 is Chris's high-yield savings account at 4.35% APY. Gross interest earned comes to $870 for the year. After federal and state income taxes at that same combined 27% rate, Chris keeps roughly $635. That is a real improvement over Lisa, and it reflects a genuinely smarter decision. The gap between $61 and $635 is significant, and moving to a high-yield account is absolutely real progress. Scenario 3 is a short-term treasury bill ETF, using a fund like SGOV as the vehicle. The The trailing 12-month yield on that type of fund as of mid-2026 sits around 3.9%, with the current 30-day SEC yield closer to 3.5%. On $20,000, that generates approximately $780 in gross income at the trailing rate, or around $700 at the current rate. Those numbers are lower than Chris's gross interest, and that is worth acknowledging directly before going any further. Here is where the comparison shifts. Interest earned from U.S. Treasury securities is exempt from state and local income taxes under federal law. That is not a loophole or a gray area. It is a structural feature of how Treasury income has been taxed since the beginning. So while Chris pays federal plus state taxes on every dollar of his $870 in gross interest, the SGOV investor pays only federal tax on their $780. After federal tax at 22%, the SGOV investor keeps approximately $608 at the trailing yield. Chris keeps $635 after his combined 27% tax rate. The gap between those two outcomes is $27 in favor of Chris. On a pure dollar basis in this specific scenario, Chris is slightly ahead. That's an honest reading of the math, and in a state with no income tax, Chris wins the comparison more decisively. But the raw numbers only answer part of the question. Chris's 4.35% is a rate that his bank controls completely. They can reduce it next month, send an email notification, and there is nothing Chris can do except move his money and repeat the process. SGOV's yield moves with actual Treasury bill rates set at U.S. government auctions. It is transparent and market-driven, not subject to a bank's internal decision about how wide to keep their spread. The deeper point is structural. Chris is still operating inside a system where a bank captures the difference between the market rate and what they pay him. A Treasury ETF eliminates that layer entirely. You are lending directly to the federal government and receiving the full market yield, minus an annual expense ratio of 0.09%. On $20,000, that fee totals $18 per year. The middleman is gone. So here's what the practical move actually looks like, and it is simpler than most people expect. The starting point is keeping your existing checking account intact. You still need a place for daily spending, bill payments, and the routine inflow and outflow of your financial life. Nothing about this approach requires dismantling what you have. The goal is narrower. Identify the money that is sitting still, not cycling through your expenses, not earmarked for anything in the next several weeks. That is the pool this strategy is designed for. Every household has a version of idle cash, even if they have never labeled it that way. It might be an emergency fund, savings building toward a future purchase, a down payment growing toward a target number, or simply a balance that has been sitting in a savings account for months without being touched. Whatever the amount, that money is currently funding someone else's lending operation, while you receive a fraction of the return. The practical question is what to replace it with. 3 alternatives give you the ability to capture more of that yield directly. The first is a Treasury bill, ETF, with SGOV being one of the most widely held options in this category. You purchase it through any brokerage account you already use, exactly like buying a stock. The fund uses investor capital to buy Treasury bills with maturities of 3 months or less, then distributes the accumulated interest as a monthly dividend. The annual expense ratio is 0.09%, which on $20,000 works out to $18 per year. Those distributions carry the state and local tax exemption that applies to all Treasury income. When you need your money back, you sell during normal market hours and receive settlement within 1 to 2 business days. The second route is Treasury-direct.gov, the federal government's own direct platform for purchasing Treasury bills. There is no brokerage involved, no ETF structure, and no expense ratio of any kind. You create an account, link your bank, and buy bills at government auction. At maturity, your principal and earned interest return to your linked account automatically. The constraint worth understanding up front is that bills purchased through this platform cannot be sold before their maturity date. and available terms range from 4 weeks out to 52 weeks. For money you are confident you will not need. During that window, this is the most direct version of the strategy. The third option is a money market fund through a major brokerage. Fidelity, Schwab, and Vanguard each offer versions of these funds. And if you specifically select a Treasury-only money market fund, every dollar is invested in short-term government securities. Current yields in this category are broadly competitive with high-yield savings account rates. The key advantage over the ETF approach is daily liquidity. There is no settlement window. You can access your balance on any business day, which makes this option particularly well-suited for people who want to keep an emergency fund in something more productive than a bank savings account without accepting any delay in access. The question of FDIC insurance comes up reliably at this point, and it deserves a precise answer. The FDIC protects up to $250,000 per depositor per bank in the event of a bank failure. That protection is real. But Treasury bills and Treasury-only money market funds carry the direct backing of the same U.S. federal government that created the FDIC and stands behind its guarantees. When a bank deposit is FDIC insured, the ultimate backstop is federal creditworthiness. When you hold a Treasury bill directly, you have removed the bank from the chain and hold that same federal obligation without an intermediary. The safety floor is identical. The structure is simply more direct. The access question is worth examining just as carefully. SGOV settles in 1 to 2 business days after you sell. A Treasury-only money market fund provides same-day access. A savings account at a major national bank often takes 1 business day for an external transfer to clear regardless. For the genuinely rare scenario where you need a large sum available within hours, keeping 1 to 2 months of expenses in your checking account handles that cleanly. The idle cash sitting in savings that has not moved in 3 months does not need to be instant. It needs to be productive. One variable that legitimately shifts the comparison is state income tax. If you live in a state with no income tax, the Treasury exemption provides no incremental benefit over a high-yield savings account because state tax on savings interest is already zero. In that situation, the direct yield comparison between your HYSA rate and the current Treasury rate becomes the deciding factor. At a 4.35% HYSA versus a 3.9% Treasury yield, the HYSA wins on gross income in a no-tax state, and the numbers reflect that clearly. The case for moving to Treasuries becomes strongest in states with meaningful income tax rates, and the advantage scales directly with your state rate. Lisa was responsible. She saved her money, kept it in a trusted institution, checked her balance every month, and felt secure doing it. By every rule she had ever been taught about personal finance, she was doing it right. Chris was informed. He researched his options, moved his money to a better account, and earns meaningfully more than the average American saver. Both of them made reasonable decisions with the information they had. The gap between their thinking and what is actually available to them is not a matter of effort or discipline. It comes down to a single question neither one ever asked. That question is, what is my bank doing with this money? And can I do it myself? The answer is yes, and the mechanics are genuinely accessible to any investor with a brokerage account. Treasury bills are not instruments reserved for large institutions. SGOV functions like any other stock you already own. A Treasury-only money market fund is as simple as selecting a different option inside an account you may already have open. The barrier is not complexity, it is awareness. The practical framework is simple. Keep your checking account funded for regular expenses. For your emergency reserve, a Treasury-only money market fund provides daily liquidity while capturing the actual government yield rather than whatever a bank decides to pass along. For idle cash beyond that reserve, money that sits for months without being needed, a Treasury ETF or a direct bill ladder through Treasury Direct gives you the full market rate with no institutional middleman taking a spread. In any state with meaningful income tax, the Treasury exemption on state and local taxes strengthens that comparison further with every percentage point of your state rate. The core shift here is not about chasing higher returns. It is about recognizing that the accounts most people use for safe cash storage were designed to generate profit for the institution that holds them, not for the person who earned that money. Your bank's job is to maximize the spread between what it pays you and what it earns on your deposit. Your job is to decide how much of that spread you are comfortable handing over. Every dollar sitting in a low-yield account when a more direct alternative exists is a quiet, automatic transfer from your balance to theirs. Across the full balance of your idle cash, compounded over years, that number stops being invisible.